Back in 1972, the legendary investor Benjamin Graham, the father of value investing, he took on this puzzle that had totally flipped the financial world on its head. So in this explainer, we're going to dive into a really key chapter of his masterpiece, The Intelligent Investor, and see how he cracked a market mystery that is, believe me, just as relevant today as it was back then.
Okay, just imagine for a second. It's 1972. You've got some cash, and you want to invest it for some nice, steady income. You've really got two main options. You can buy stocks, a piece of America's biggest companies, or you can buy super safe government bonds. Where are you going to put your money for the best return? Seems like a pretty obvious choice, doesn't it?
Well, take a look at this. Back in 1949, stocks were paying out a really healthy 6.8%, totally crushing the 2.6% you'd get from bonds. But fast forward to early 72, and the whole world had turned upside down. Stocks were yielding a teeny tiny 2.76%, while boring old government bonds, they were paying out a massive 7.19%. I mean, that's more than double the income from the asset that's supposed to be safer.
But here's the twist. As Graham would so brilliantly show us, that obvious choice to just pile all your money into those high-yielding bonds, well, it wasn't necessarily the intelligent one. This really strange new reality created this huge dilemma for investors, and Graham, well, he set out to solve it.
So let's really set the stage for this financial showdown. Because to really get Graham's solution, we first need to appreciate just how big of a problem this was for investors. This wasn't just some small market shift, it was a total reordering of everything they thought they knew.
I mean, the sheer scale of this flip is just staggering. In a little over 2 decades, the market went from a world where stocks had a 4-point advantage to one where bonds had a 4-point advantage. So the central question was, what is a smart, defensive investor supposed to do when the entire world looks completely upside down?
You see, Graham's genius was that he looked right past those simple yield numbers. He argued that the answer wasn't really in the math, it was in the mood. He knew that to understand the market, you first had to understand its psychology. Those wild swings between fear and greed?
And this visual just perfectly captures his core idea, the market pendulum. Graham saw the market as this pendulum, constantly swinging back and forth between unjustified optimism, which makes things dangerously expensive, and unjustified pessimism, which, well, that's what creates incredible bargains. The intelligent investor's job isn't to predict the swing, but to figure out where that pendulum is at any given moment.
And he actually measured this swing using a really important metric, the price-to-earnings ratio, or PE. This timeline here kind of shows how the market's mood changed over time. In 1948, the pendulum was stuck deep in pessimism. Stocks were dirt cheap. By 1968, it had swung all the way to the other side, peak euphoria, where stocks were priced for absolute perfection. By the time he was writing, things had cooled off a bit, but that memory of euphoria was still very fresh.
Now, to make this whole pendulum idea feel real, Graham used this incredibly powerful case study. He showed how these mood swings played out in the real world with the stock of a company everybody knew, the Great Atlantic and Pacific Tea Company, or just A&P.
This chart, it tells the entire story. It is a perfect, real-life example of how the market's perception of a company can get wildly, completely detached from how the business is actually doing. It swings from being a crazy bargain to being dangerously overvalued and then, finally, crashing back down.
So let's start in 1938. The pendulum is at maximum pessimism. A&P was a solid, profitable grocery store chain, but coming out of the Great Depression, the market just hated it. Graham said the stock was, and I quote, really being given away, which created this huge opportunity for anyone who was willing to just ignore the crowd's fear.
Okay, now, let's fast forward to 1961. The pendulum had swung to the absolute opposite extreme, total mania. The stock price just exploded, and the reason? Pure, unjustified hype. Investors just fell in love with the story about growth, and they bid the price up to these absurd levels based on, well, nothing but euphoria.
How absurd are we talking? Well, A&P stock was trading at 30 times its earnings. 30! That was way, way higher than the market average and was basically pricing in this spectacular growth that the business just couldn't possibly deliver. The point is, the price had lost all connection to reality.
And as Graham himself put it, the crowd was in a total frenzy. This quote just captures the very essence of a market bubble. Emotion completely steamrolling any kind of rational thought. People weren't buying a business anymore, they were just buying a story.
And of course, the story had a pretty unhappy ending. By 1972, that pendulum had swung back hard. The hype was gone, earnings started to decline, and the stock crashed, all the way from over $70 down to $18. The market finally woke up to the fact that the business itself had just become,
Well, mediocre. Reality always wins in the end.
So, if you can't trust the market's mood, what can you trust? This brings us to what is probably Graham's single most important idea in all of investing: the margin of safety. It is such a beautifully simple but really profound idea. You protect yourself not by trying to predict the future, but by demanding a discount today. You only buy something for significantly less than what you think it's truly worth. That gap, that's your margin of safety. It's your cushion against bad luck, bad timing, or just, being plain wrong.
And he applied the same discipline to your entire portfolio. So instead of trying to perfectly time the market, he gave this simple, almost mechanical rule. Just keep your mix of stocks and bonds somewhere between a 25 and 75% range. This simple rule prevents you from making huge, crazy bets at the absolute peak of euphoria or in the depths of despair. It's a strategy that's built for survival.
Now look, this was all written 50 years ago. So why on earth are we still talking about it? Well, it's because the fundamental lessons are absolutely timeless.
It all really boils down to just a few key lessons. Graham teaches us that history gives us a map, that the market's mood will always swing between fear and greed, that great companies can become bad ones, and that your margin of safety is your absolute best defense. And ultimately, having a disciplined plan is almost always going to beat making an impulsive decision. The technology changes, the company names change, but human nature, that doesn't. Which really leaves us with a final thought. That market pendulum, it never stops swinging. It's swinging right now, as we speak. And Graham's work teaches us that the most important job of any investor isn't trying to guess where it's going next, but to simply stop and ask, where is the pendulum now?